Good morning, and welcome to your comprehensive look at the latest movements in the European markets. As the sun rises over the continent, investors and analysts alike are closely watching the numbers, eager to see how the week will unfold. Today, November 24th, European stock markets are opening strong, with share prices rising across major financial centers like Frankfurt, Paris, and London. The early trading session has already seen a notable uptick, with green arrows dominating the tickers and a sense of renewed energy on the trading floors. This broad optimism comes after a period of uncertainty, especially following recent concerns about the high valuations of tech stocks. Now, with those worries easing, we're seeing a wave of renewed investor confidence sweep through the markets. Traders and investors are reacting positively, and there's a sense that the worst of the volatility may be behind us, at least for now. A key driver behind today's gains is growing hope that the U.S. Federal Reserve may soon cut interest rates. Such a move would make borrowing cheaper, not just in the United States, but potentially around the world, encouraging businesses to invest and consumers to spend. This anticipation is fueling optimism across global markets, as lower rates often translate to higher stock prices and increased economic activity. Meanwhile, local events are also shaping the mood. In the UK, all eyes are on the government as it prepares to unveil new budget plans, which could have significant implications for public spending and economic growth. Over in Germany, investors are awaiting the release of important business data that could provide fresh insights into the health of Europe's largest economy. These developments are adding an extra layer of anticipation to the week's trading. All these factors, global monetary policy, local fiscal decisions, and key economic indicators, are combining to create a cautiously optimistic mood as we start the week. Market participants are balancing hope with caution, aware that while the outlook is improving, challenges remain on the horizon. The gains we're seeing this morning suggest that Europe's economic engine is still running smoothly. From the bustling financial districts to the factories and transport networks that keep the continent moving, there's a sense of resilience and forward momentum. In this video, we'll break down the key reasons behind the rise in European stocks, take a closer look at what's happening with the U.S. Federal Reserve, discuss what to expect from the upcoming UK budget announcement, and explore how global events are shaping investor sentiment. We'll also examine how these trends could impact your investments and what to watch for in the days ahead. By the end of this video, you'll have a clear and detailed understanding of the forces moving the financial world today and what they could mean for the future. So, let's dive in and explore the stories behind the numbers. Scene transition. Let's look at the numbers in Europe's biggest financial centers. Germany's DAX is up 0.7%, reflecting strong confidence in its top companies. France's CAC 40 has risen 0.6%, with luxury brands and banks leading the way. The UK's FTSE 100 is up 0.4%, a positive sign ahead of key government announcements. These gains follow a wave of optimism from Asian markets, showing how global trends boost local confidence. For now, investors are betting on a brighter economic future for Europe. Scene transition. One of the biggest forces behind Europe's recent stock market rally isn't just local economic news or company earnings. Instead, it's a wave of optimism coming from across the Atlantic. Investors and analysts alike are closely watching what's happening in the United States, and for good reason. The hope for a U.S. interest rate cut is sending positive shockwaves through global markets, especially in Europe. The Federal Reserve, America's central bank, is signaling that it may soon lower interest rates. This move would make borrowing cheaper for banks, businesses, and everyday consumers, both in the U.S. and indirectly around the world. The mere prospect of easier borrowing is enough to excite investors worldwide. When money is less expensive to borrow, companies can invest more in growth, hire new workers, and expand operations. Consumers, too, may feel more confident to spend, boosting the overall economy. Recent comments from top Fed officials have only fueled these expectations, with many now betting on a rate cut as soon as the December meeting. This anticipation is being closely tracked by financial professionals everywhere. Lower U.S. rates don't just affect Americans, they ripple across borders, making it cheaper for European companies to borrow, invest, and compete on the global stage. Often, when the U.S. central bank acts, other central banks feel pressure to follow suit, creating a domino effect that can stimulate economies worldwide. This renewed optimism is helping markets recover from recent tech stock sell-offs and other global uncertainties, giving investors a reason to feel hopeful again. As savings account rates fall, investors are moving their money back into stocks, searching for better returns and new opportunities in a changing financial landscape. The hope for lower rates is a powerful motivator, driving today's positive sentiment and encouraging risk-taking that can fuel further growth. Even decisions made in Washington, D.C. can quickly ripple out to impact markets in Frankfurt, Paris, and beyond, showing just how interconnected our financial world has become. That's the power of a connected global economy, where a single policy shift in one country can lift spirits and move markets around the world in an instant. What's an interest rate cut? It's a term you'll hear all the time in financial news. But what does it really mean, and why does it matter so much to everyone from Wall Street traders to everyday families? Think of the economy as a car. Interest rates are the brakes. When the economy is speeding up too quickly, central banks use these brakes to slow things down and keep everything under control. When growth is too fast, central banks raise rates to slow things down. This makes borrowing more expensive, which cools off spending and helps prevent inflation from spiraling out of control. But when the economy needs a boost, maybe after a slowdown or a crisis, central banks cut rates. This makes it cheaper for people and businesses to borrow money, encouraging them to take out loans, invest, and spend more freely. Lower rates mean cheaper mortgages for homebuyers, more affordable car loans, and easier access to funds for businesses looking to expand. This ripple effect can lead to more jobs, higher wages, and a stronger economy overall. For families, it might mean finally being able to buy that first home or start a new business. For companies, it could mean hiring more workers or launching new projects. The benefits can be felt across the entire economy. For stocks, rate cuts are good news. Companies can grow more easily, and investors seek higher returns in the market as savings rates drop. This often leads to a surge in stock prices as investors move their money from savings accounts to stocks in search of better returns. This cycle of cheaper money and rising stock prices is why markets rally on rate cut hopes. Investors anticipate that lower rates will fuel growth and boost company profits. Even the expectation of a cut can send shares higher, as traders try to get ahead of the curve and position themselves for future gains. It's a key reason for today's market optimism. When central banks signal that cuts are coming, it can lift the mood of investors and businesses alike. Understanding this helps explain why global markets react so strongly to central bank signals. These decisions don't just affect banks, they ripple through every part of the economy, shaping everything from job prospects to investment returns. Scene transition. In the UK, all eyes are on Wednesday's autumn budget from Finance Minister Rachel Reeves. The budget outlines government tax and spending plans, directly impacting the economy and markets. This year, significant tax increases are expected as the government aims to balance the books and control borrowing. Higher taxes can slow growth and reduce company profits, making investors cautious. The government faces a tough task: raise revenue without stalling the economy or spooking markets. Investors want stability and a clear plan for the nation's finances. The FTSE 100's modest rise shows optimism, but also caution ahead of this crucial announcement. The budget's details will be closely watched by businesses and households alike. What's announced could shape the UK's economic outlook for months to come. Scene transition. Today, Germany releases the Ifo Business Climate Indicator, a key measure of business confidence. This survey asks thousands of German business leaders about current conditions and future expectations. A higher Ifo number signals optimism and likely economic growth. A drop warns of caution or slowdown. Forecasters expect a slight improvement this month, hinting at renewed confidence after recent uncertainty. For Germany, a manufacturing powerhouse, business sentiment affects not just its own economy, but also its European partners. Investors and policymakers across Europe watch this data closely. A positive reading could boost markets further, while a weak result might dampen the mood. The Ifo is just one of several key data points shaping Europe's economic outlook this week. Scene transition. This Friday is Black Friday, the kickoff to the holiday shopping season, and a crucial time for retailers. Many companies make a large share of their annual sales in these weeks, so strong Black Friday results are vital. Retailers offer big discounts to attract shoppers, and consumer spending during this period is a key indicator of economic confidence. After a year of high inflation, everyone's watching to see if shoppers will splurge or hold back. Black Friday and Cyber Monday sales will give the first real clues about consumer health. Strong sales can lift retail stocks and boost overall market sentiment. Weak numbers, however, could raise concerns about a slowdown. Scene transition. Global events are also shaping markets. In China, Alibaba's stock jumped after a successful launch of its new AI app, Quen, renewing investor faith in its tech strategy. This shows how innovation can drive individual stocks, even amid broader economic uncertainty. Meanwhile, oil prices have steadied after recent volatility, with Brent crude around $61 a barrel. Peace talks between Russia and Ukraine are a key factor. Any deal could increase oil supply and push prices lower. Lower oil prices benefit businesses and consumers by reducing costs and easing inflation. The energy market remains sensitive to headlines, and oil's direction will influence global growth. These stories highlight how tech breakthroughs and geopolitical events can quickly shift investor sentiment. Scene transition. 10. So, what does all this mean for you? Global events, from US rate cuts to UK budgets and oil prices, directly impact your savings, job security, and daily expenses. If you have investments or a pension, rising markets can boost your financial future. Even if you don't invest, government decisions and energy prices affect your paycheck and household budget. Understanding these connections helps you make smarter financial choices. Today's market optimism is part of a bigger story that touches us all. By following these trends, you can see how global finance shapes your everyday life. Thanks for watching. Stay informed, and see you next time.